So our starting point today will be solving question number 22 in December 2022, yeah? So be reading through question number 22. Yeah, so allow me to make a clarification that the questions we have attempted so far, yeah? Remember, I have had this kind of info, yeah? What I'm projecting on your screen, what I am projecting on your screen, yeah? So we've had this kind of info, whereby for the periods, the cash flows have been summarized, and that made it very easier to really be able to compute NPV and the related measures. Now, sometimes questions will not really come that way, yeah? In the sense that you may have where we have raw data provided, so that from such raw data, you'll be required to extract. You'll be required to extract and summarize information in this form, yeah? So you'll be required to extract and summarize information in this form, which I am showing, yeah? Now, what question number 22 tests, remember, is whether you are in a position to be able to extract and summarize, remember, information into this form, from which you can then proceed to compute now NPV. So that is what question number 22, yeah? Then tests on. When you have that raw data, are you able to summarize it and of course be able to come up, yeah, with this kind of info, which from you can compute now NPV. So I think with that we can then proceed, yeah, to solve the question. And the question, we are told, has 3 requirements. We have part A, part B, and C, whereby part A says that we compute the weighted average cost of capital to be used, remember, to evaluate the project, yeah? So we'll start with that part A. We'll start with that part A. We are computing the weighted average cost of capital, which, remember, commonly we abbreviate as WSEC. And how do we proceed to compute this? Now, from what you are taught because in financial management, you have to remember that this equals what? This equals what we call the real weighted average cost of capital. Remember, adjusted by expected changes for the project, expected changes for the project. The weighted average cost of capital that we are looking for, yeah, note that is for the project, so that we determine that as what is the real weighted average cost of capital before the project. Then adjust it by the changes you expect, remember, for the project. The question tells us that the real weighted average cost of capital, that has been given as what percent? Go to note number 9. If you go to note number 9, we are told that this is 8%. The changes we expect as per the project in the same note 9, we are told that we have 2 changes. One is the general inflation. One is the general inflation. And when you have inflation, does it mean increase or decrease in cost of capital? Somebody. When you have inflation, does this mean that cost of capital increase or decrease? Yes. When you have inflation, does it mean increase or decrease? Yes, someone, Maureen, Lillian. Does inflation make the cost of capital increase or decrease? Yeah, so Lillian says in the chat that that is increase. So that is true, that inflation means you increase cost of capital. So the inflation increase we are told would be 4%. So you add the 4% to the real. You add the 4% to the real. Apart from that, remember in the same note number 9, the last statement, what are we told? That due to the risk of the project, Jane feels that the relevant nominal weighted average cost of capital would again be increased by 3%. So apart from inflation, we have another increase. We have another increase. And this other increase is 3%. 3%. Because we are not told of another, then that is it. The total is that 15%. So that that is the answer to what is required in part A. So what's important to remember, you take the real weighted average, adjust that by the changes you expect over the project period. In the context of this question, we expected 2 changes. One is an increase by inflation, the 4%. Then secondly, another increase by 3%. When you add all, then we have that 15%. So is that clear? Is that clear? So is that clear? All right. Let us then proceed on to part B. Part B says that we determine or compute the relevant cash flows over the project period. So part B is relevant cash flows over the project period. And when you talk of the relevant cash flows, what do we mean? Remember, we mean the summarized cash flows per period, which based on we compute NPV. And in that respect, I refer back to the first 2 questions we did, yeah? Where provided were the summarized cash flows, which based on directly, we calculated NPV, So in this case, we are given very raw data about the expected future project. Are we able to summarize that data to give us summarized cash flow over the project life? Now, which cash flows do we need to determine together? Which cash flows do we need to add up? That then gives us what we summarize as the relevant cash flows. So the first thing to appreciate is this. We have a number of cash flows which we need to add up for the periods. And so per period, we look at these cash flows. At the end of the day, we shall add them up. Where we need to net, we shall net. Come up with single cash flows per period, which based on we compute the NPV. We are going to start by saying that we have periods. We have the periods. And remember, we do start with year zero. Year zero is when we normally do the initial outlay. So that we then have year one, we then have year two, we then have year three. Now the project we were told has a useful life of how long? When you look at note number 1, the project has a useful life of 5 years. So we have year 4 and lastly we have year 5. So that very quickly, which cash flows do we consider? Which cash flows do we need to consider here? Which cash flows do we need to consider? We have so many cash flows. Which is the first one to consider? Of course, in year zero, we do the initial outlay, so that the first cash flow become that initial outlay. And how much are we told that we shall inject in the project in year zero? How much are we investing in the project in year zero? The initial outlay we are told is how much? Somebody? The initial outlay, we are told that this is how much? Somebody? Yes, somebody? How much is the initial outlay? Yes? Somebody, how much is the initial outlay? Yes? So when you look at note number 2, you are told that Trucks Limited will require the purchase of a machine at a cost of 100 million shillings. So the initial outlay is therefore 100 million. Being money you spend, that's a negative. So being money you spend, that's a negative. So I will have negative 100 million. Remember, under period what? 0. The initial outlay apply just for a period 0. So you do not have it in year 1. You do not have it in year 2. So that I'll have a 0 under year 1, a 0 under year 2, 0 under year 3, 0 year 4, and 0 year 5. Apart from the initial outlay, what other cash flows are we told that we have? When you look at the same note number 2, the question says in the last part of it that after which the machine will be sold for 20 million shillings at the end of the 5th year. When you sell the machine, you receive in return cash. So with respect to the sale at the end of the last year, the next cash flow is what we call the sale proceed. And this, the question say, will amount to 20 million shillings. In this case, this will be a positive. Remember, because this is the money you receive. So that will be a positive. That means that in year 0, this does not apply. In year 1, this does not apply. Year 2 does not apply. Year 3, and also year 4. So the asset is sold at the project end. That therefore apply for year 5 only. So far we have 2 cash flows: the initial outlay and then the sale proceed. Now the next cash flows become those in note number 3. When you go to note number 3, the question says that the selling price and the cost structures of Trex Limited for the first year 2023 with expected inflation of factors are then as follows. We are told, 1, we have selling price, which based on, remember, we will have a cash flow in terms of the sales revenue. So the next cash flow will be sales revenue. After the selling price, we are told we have material cost. So we shall have an expenditure that we shall call the material cost. After that, we are told we shall have direct labor. So again, we'll have an expenditure that we call the direct labor cost. And then lastly, in that note number 3, another expenditure shall be the incremental fixed costs. So those are therefore cash flows which we must look for. Those are therefore cash flows which we must look for. The other cash flows that we must look for, refer to note number 5, yeah? Refer to note number 5, where again we are told that at the end of the project, when the machine is sold, any gain or loss on disposal will be considered for taxation. Normally in accounting, when you sell an asset, you sell at a profit or at a loss. And that is what the question talks about in that note, that whatever profit or loss on a sale of the asset, you will subject that, remember, to taxation. When, for example, you get a gain, that's an income which attracts a tax liability that you pay for. In case you have a loss, that will attract a tax refund, which will mean that from the tax authority, you receive cash as a tax refund. Being a cash flow, that is also considered here. So the next cash flow will be the tax on disposal gain or loss. What else? What else is the next note is note number 6. When you go to note number 6, we have something else. That the tax rate on income and capital allowance is at the rate of 30% per year. Assume that the tax for a given period is paid. Remember, in the same period. Of course, for this entity, an income statement will be prepared. For the income statement, you shall determine the profit for the period. For example, when you make a profit that attracts taxation, so that another cash flow, because that we have to pay for, yeah, another cash flow become the tax on profit for the period. The tax on profit for the period. The tax that we shall pay on the profits we make each period, meaning we shall have to compute the taxable profit per period. Then on that profit, we shall compute taxation. All right. Next will be note number 7. Next will be note number 7. In note number 7, we are told that the project will require an initial investment in working capital, remember, of 20 million shillings, which will be increased by 5 million shillings at the end of each year. Remember, to cater for general inflation. The whole amount, together with the periodic increase, will, however, revert, we are told, at the project end. So we saw that the question requires an initial outlay. Apart from the initial outlay, we are told they will also require the additional working capital, so that we will have another cash flow will be the additional working capital. The additional working capital, we are told that initially, and when we talk of initially, we mean the initials are in year 0, remember. So initially in year 0, that means at project start, we have an initial outlay. In terms of working capital, we are told of 20 million. The question then says what? In the subsequent years, there will be an increase by 5 million. That means in year 1, we'll have 5 million shillings. 5 million shillings an increase. The same will apply to year 2. The same will apply to year 2. The same will apply to year 3. Another increase, and the same will apply to year 4. So in each of the years, you will have an increase by 5 million shillings. So initially, you shall have an outlay of 20 million shillings That's in year 0. In the years which follow, you will have an increment by 5 million. So that means increase of 5 million year 1 to year 4. What are we told about year 5 at project end? What happens? Look at the last statement, note number 7 again. The question says that the whole amount together with the periodic increase will, however, revert at the project end. What does reverting mean? When you are told that the whole amount of 20 million initially plus the 5 million increase here 1 to 4 all revert come year 5. What does this mean? Someone? Yes, somebody, what does this mean? Yes? Somebody, what does this mean? This means that come year 5, we recover this money. To revert is to do the opposite of what has happened before. These are cash outflows which we have been paying out from year 0, remember, to year number 4. When you are told in year 5 they revert, it means we receive them back. So that we shall receive back in year 5 that summation, the sum of all these cash flows. And because we are receiving them back, remember, they become a positive. Therefore, in year number 5, so they become a positive. So I'll say that this equals what? This equals negative. This equals negative, or let me just say that this equals negative in bracket sum of so that equals negative sum of all these cash flows and when I do that, you can now see that we have 40 million positive. So it reverts the 40 million we receive in cash. so that the point on the additional working capital reversing, yeah? Does it, is it clear? Does it make sense to you people? Is that clear enough? Lillian? Yes? Is it clear enough? Lillian, are you there? Maureen? So Lillian is asking, why is it 40 million and not 20 million? Yeah, Lillian, it is 40 million because you add from this, yeah? These are the cash flows which revert. You know, initially in year 0, you have 20 million output. And then from year 1 to 4, you have 5 million per year. So when you add all of them, yeah, they make 40 million. So is that okay? Is that okay? All right. So if that is the case, then when I look at note number 8, we are told that experience has shown that demand for new product is not exactly known in year 1, but then tends to be stable thereafter. Jen has come up with the following estimates of demand for year 2023. So in that case, that's a matter of the demand units. We do not have a cash flow in that note. That's about the units we anticipate to sell. Note number 9, we have dealt with that. So I do not think we have another cash flow, yeah? I do not think we have another cash flow. So once we can determine these cash flows and add them, yeah? Then the total we shall get is what the question called the relevant cash flows. That is what the question calls the relevant cash flows. So once we can determine all, and of course add them, get their summation, that summation is what we shall call the relevant what? Cash flows. So the task which we are then faced with, yeah? The task which we are then faced with is to now determine the rest of the cash flows per year. When it is, for example, the sales revenue, when it is, for example, the sales revenue, how much is it per year? Now, for something like revenue, remember, yeah, we calculate revenue as the sales units, because the question gave us the units in note number 8. This multiplied by what? The selling price. The selling price now per unit. And I want to believe that the same will apply for the rest of the costs, the material costs, the labor cost, and then the incremental costs. Because we had the per unit figures, then it's a matter of how many units do you have, yeah? Then times the per unit figure. Like now for the sales revenue, how many units are they, for example, for period 1? So let me then proceed to have a working. Let me then proceed to have, actually, let me call them workings. And number 1 will be about determining the sales revenue. I've said that we determine sales revenue as the number of units times the selling price per unit. So somebody to tell me, how many units do we work with in period 1? In year number 1, how many units do we work with? So in the first period, how many units do we work with in calculating the sales revenue? So how many units do we work with? Somebody? So Lillian says that the expected sales units in 2023, yeah? Lillian, how many units are the expected? What number of units are the expected in 2023? Yes, Lillian. What's the number of What is the expected number of sales units? So normally, how do we get expected number of units? You take, the units for the year 2023 were, the question was clear that it is not exactly known, yeah? And so we had it in terms of probabilities. The first probability was 30% when the units are expected to be 40,000. Then the next probability, we have 40% when the units are expected to be 30,000. And then the last probability, we have 30% when the units are expected to be 10,000, yeah? If we were to work out the expected units, if we were to work out the expected units, for the first probability, we have 30%, remember, multiplied by 40,000, and the same will apply for the other probabilities. So that ideally the expected number should be that summation. The expected number should be that summation, so that the expected number of units for the first year. For the first year, we then have 27,000, yeah? So that's what we call the expected. That's what we call the expected units. Now, the expected units apply for year one. So the 27,000 will apply for year number one. The 27,000 will apply for year number one, yeah? Now, what about year two onwards? Go back to note number 8. Go back to note number 8. Go back to note number 8. Note number 8 says that the last statement in note number 8 says that Jane expects an initial increase in demand in year 2024 of 25%. So in the second year, we expect an increase of 25%. So in the second year, we expect that this demand increases, this 27,000 increases by 25%. So I will multiply by 125%, which will give us 33,750. Which will give us 33,750. And then we are told then a decline of 50% in year 2025. So then a decline of 50% in year 2025. So when we go to year 3, year 2025, we will have the 2024 33,750, we expect it to decline by 50%. So times, I will multiply that by 50% to half it, so that's what we get in year 3. So that after the decline by 50% in year 2025, we are told that this level will remain the same till the end of the project. So this level for year 3, the 16,875, will remain the same until the end of the project. So year 4, we have this. And then when you come to year 5, the same. The level remain the same. The level remain the same. So those are there for the number of sales units that per year over the 5 years we therefore work with. So that based on this, we can compute the sales revenue. For us to be able to compute the sales revenue, then we shall need the selling price. We shall need the selling price per unit. Per unit. When you look at note number 3 once again, we had the per unit figures. We had the per unit figures. We had the per unit figures. And the question was very clear that the figures in note number 3 apply for the first year, 2023. So the price per unit in 2023, this we are told is 5,000 shillings. So that's 5,000 shillings. What about year 2 to 5? Remember, the price cannot remain the same because we have the expected inflation rate. For the selling price, we are told that from 2024 onwards, the inflation per year, inflation is normally per year, yeah, will be 2%. Will be 2%. So inflation means you increase the price. So when I go to year 2, this will equal the price in year 1 multiplied by 1.02. If I multiply by 1.02, it means I've increased by the inflation of 2%. So year 2 will get that. Then you can apply the same formula until year 5. So then you can apply the same formula until year 5. Then you can apply the same formula until year 5. So this will mean that we can now compute the sales revenue per year. So that, for example, for period 1, I will take the expected units 27,000. I'll take the expected units 27,000. I will multiply this by the price per unit 5,000. The total revenue for year 1, that's 135 million. So remember that apply for year 1 and not year 0. That apply for year 1 and not year 0. So skip year 0. Year 0 does not have revenue. So that's a 0. It is in year 1 when you have that. So you'll, for the rest of the years, compute it in the same manner. Yeah? So I can very simply, again, apply the same formula to the last year. So that is that clear for the revenue? Yes? Is that clear for the revenue? Yes, is that clear for the revenue? All right, thank you very much, Lillian. So we proceed on to the next cash flow. The next cash flow become the material cost, yeah? So that working number two, we then have material cost. The material cost also, we had the information provided per unit, meaning that we first get the material cost per unit per year. Then again, we multiply by this expected number of units, which we already have. So what we need as working number two is then the material cost per unit. So again, when you go to note number 3, the material cost for the first year we are told should be 2,000 shillings. The material cost for the first year, 2,000 shillings. Expected rate of inflation is 4% onwards, 2024 onwards. So we shall increase this by 1.04. We get 2080, then apply the same formula to the last year. Then apply the same formula to the last year. To therefore get material cost for year 1, yeah? Of course, in year 0, there is no material cost. You then compute it from year 1. So that computing it from year 1 means that equal to, I take the price per unit in year 1, I multiply by the expected units in year 1. That's what I get. But of course, for the material cost, remember, yeah, remember, that's a payment we make. So it cannot be like the revenue, which we had as a positive. Material cost is an expenditure, which is a payment you make. So you need to make that figure a negative. What I'll do is to before this cell, I will add a negative so that I get 54,000 bracketed. So that's a negative because it's a payment that we make. Again, I will then apply the same formula to the 5th year. So that once again is that okay? The calculation for the material cost, is that fine? Is that okay, or you have a query? Is that okay? Or there's a question? Yes, could you confirm that we are together and that's fine? Is somebody with me in class, or we are not in? Yes. All right. We then proceed to the next cash flow, which is the direct labor cost. So in the same manner, once again, yeah, what we need to determine is the direct labor cost per unit. Again, when we go back to note number 3, the direct labor cost for the first year we are told is 1,000 shillings. And then we are told the expected rate of inflation is 5% onwards, 2024 onwards. So it will be the 1,000, we increase it by, so times 1.05. That's what we get. Then of course we apply the same formula to the last year. So again, for the direct labor cost, year 0, we do not have it. When you come to year 1, labor cost per unit for year 1 times the number of units again. What we get for year 1 is 27 million. So again, because we want that as a negative, I'll just put minus before the first cell in that formula, so that we have minus 27. Then I apply the same formula to the last year. The next cost we said is the incremental fixed cost, which as per note number 3, once again, we need to determine the incremental. We need to determine the incremental fixed cost per unit. And that for year 1, we are told is 500 shillings. In year number 2, we are told we expect an inflation of 10%. So that times 1.1, we get 550. Then I apply the same formula to the last year. So again, back to my cash flows, year 0, the incremental fixed is a 0 in year number 1. The per unit incremental times the expected number of units in year 1. Again, because I want that as a negative before the first cell, I'll just put a negative. Then I apply the same formula to the last year. So with that, of course, we are through with the information, yeah? We are through with the information which we were determining based on the per unit values. We are then left with 2 cash flows. The first one is the tax on disposal gain or loss. So for us to be able to compute the tax on disposal gain or loss, I'll make that working number 5, yeah? So that I want to look for the tax on disposal gain stroke loss. Now, how do we compute? The first thing to do, yeah, is ascertain whether we have a disposal gain or loss. We ascertain whether we have a disposal gain or what? Or loss. And how do we determine the disposal gain or loss? How do we normally compute the gain or loss on disposal? Of course, what we need to do is to compare the value of asset at disposal at disposal, yeah? We compare that with the sales. The sales proceed. We compare that with the sale proceed. Now remember, disposal happens in year 5. The disposal happens in year 5. So it's under the last year, that we analyze that item. The disposal proceed, we know how much it is. The question said that the disposal proceed is 20 million at end of year 5. So the disposal proceed is 20 million at end, remember, of year 5. So what we need to determine is the value of the asset at the time of what? Now disposal, yeah? So let's below there, yeah? Let me just do that. So I'll compute gain or loss on disposal here, then the tax. So we'll compute gain stroke loss on disposal. Then thereafter compute tax. Thereafter compute taxation. But before that, we must determine the value of the asset at the time of what? At the time of disposal, yeah? Whereby we shall start with cost stroke written down value. Remember, for the asset brought forward. Of course, for you to come up with the written down value, you need the tax, not tax, but you need to compute the depreciation for tax. You need to compute the depreciation for tax, which is the same as depreciation for tax is the same as the wear and tear allowance, yeah? Depreciation for tax is the same as the wear and tear allowance. Then, of course, we can get the written down value, carried forward. So, at the start of period 1, remember, at the start of period 1, the cost of the asset we were told is 100 million. That is the cost of the asset. The depreciation for tax, we were told about it in note number 4. When you look at note number 4, that is where we are told about it. That the company is eligible for capital allowances, that depreciation for taxation purposes at the rate of 25% on reducing a balance method, yeah? So that to get depreciation for tax for year 1, we take cost, we multiply by the rate is 25%. We multiply by the rate is 25%. We get the value carried forward as the brought forward minus that depreciation for tax. So we get 75,000. The 75,000 at the end of year 1 is what you start year 2 with. That's what you start year 2 with. And then, of course, we can then apply formulae so that this information is complete. If I apply the same formula in arriving at the brought forward balance, I'll just put your cursor at that 75, then extend to the last year. Now for the depreciation, you just extend from that for the first year. And then, of course, for the written down value carried forward, extend from that for the first year. So you can see automatically you get those figures. So the written down value at the end of year 5 is therefore the figure which I have in yellow. So that is therefore the figure which I have in yellow. Is that okay? Is it okay how I have computed the written down value at end of year 5? Is that okay? Yes, Lillian, is that okay? Yes? Also the depreciation, yeah? So the depreciation I'm saying, let me just highlight that figure, yeah? So that is how I have computed it. I have taken the value at period start. At the start of year 1, the asset has a value of 100 million. That was the initial outlay as per the question. The rate of depreciation for tax, you are told about it when you look at note number 4, yeah? When you look at note number 4, we are told about it, that the rate is 25% on reducing balance, so on the value brought forward per year. That is what gives me 25 million. The carried forward value is there for 100 million minus this 25, so you get 75. The 75 is what you start period 2 with. The 75 is what I've transferred to period 2. So that's what you start period 2 with. So you follow the same procedure until the last year. So in Excel, you can have shortcuts for that and have that figure, have the last figure easily computed that way. So is that fine? Okay. If that is fine, then this is now the value of the asset at the time we are disposing it. Remember, for us to get the gain or loss on disposal, you look for the value of the asset at the time of disposal, which is now this figure. So the value of the asset at the time of disposal, this one, I'll say is equal to this figure. We can now compute the gain or loss on disposal, yeah? So that it is the difference between the two. The difference between the two. The difference between the two. And the difference is that minus that. So you get a difference of 3730. You get a difference of 3730, which is the gain or loss. Now, if the asset was valued at 23 million at the time we sold it, but then we sold at 20 million, is the 3730 a gain or a loss? Yeah, so correct, Lillian, that's a loss. That's a loss, so that's a loss. Now, we then have to levy taxation, because the question said that the gain or loss that arises on disposal, yeah, that we tax. So when we levy taxation on a loss, what kind of tax do we get? We don't get a tax payable, we get a tax income. A tax income, which is more or less like a tax refund. A tax income or a tax refund is tax that we receive. This is not tax that we pay. This is a tax that we receive so that this become a positive cash flow. So the taxation on this will equal the loss times what is the tax rate? Now, number 6, we are told that tax rate we have 30%. So what we get is therefore the 1.1 million, which I'm saying is a tax income or a tax refund. That makes it a cash inflow because that's money we receive from the tax authority. Remember, in case you had a profits you tax and you pay taxation on it. So when you have a loss, you have the opposite. This is now a cash inflow. I therefore come back to my relevant cash flow workings and say that the tax on disposal, gain or loss, is equal to how much? Remember, it applies to year 5 because disposal happens in year 5. So I'll say equal to the 1.1 million. Being a cash inflow, that's a positive. So being a cash inflow, that's a plus. So that next and last, for the relevant cash flows, we determine the tax on profit for the period. Tax on profit for the period. So that working number 6. Working number 6, we have tax on profit for the period. Tax on profit for the period. The first thing that we need to determine is the profit for the period. The profit for the period. And profit for the period comprises what? The profit for the period comprises, number 1, the sales revenue. Comprises, number 1, the sales revenue. So I'll need here the sales revenue. And then from the sales revenue, we shall minus expenses. Expenses include, number 1, the material cost. Also include, number 2, the direct labor. Also includes, number 3, incremental fixed. Which other expenditure comes in the P&L? So we have sales revenue, that's the income. You minus all expenses, remember. So all expenses include material, the direct labor, and then the incremental fixed costs. In a normal P&L, one more thing that comes here, remember, is the depreciation. But of course, the depreciation for tax. But of course, the depreciation for what? For tax. So in a normal P&L, in this information, this is the information that you need, yeah? Remember, to be able to compute the profits per period. Now we can then copy the figures for these items. We can then copy the figures for these items so that that's it. Sales revenue for period 1. So I can simply apply the same formula for the first 3 expenditure. For the first 3 expenditure, then again I apply the same formula for the rest of the years. So in that case, what I've done is to copy the figures from the workings which we already have, yeah? And then of course, the tax for depreciation, we have just computed that in this working number 5, yeah? So I pick it from here. But again, because I want that as a negative, I'll just put minus before that formula, minus before that cell. So that again, when I copy to the last year, I have those figures. Because that is all for the expenditure, that we need to consider, yeah? Then we can get the taxable profit. The taxable profit for each period. The taxable profit for each period. The taxable profit for each period, which I now have as that. So just make sure that you have that also, so that based on this, we'll compute the tax payable. The tax payable, remember, at 30%. So based on that, we can compute the tax payable at 30%. So let me hope that that is fine, and so we can get taxation, the tax payable on profits per year, yeah? So that year 1, for example, will be that profit times the tax is 30%, so that for the rest of the years, we compute in the same manner. For the rest of the years, we compute in the same manner, yeah? So because we have made profits in each year, This is therefore tax expenditure that we pay for. The question said we assume it is paid for in the very year. So that means if I come back to my relevant cash flows working, then in year one, I will just say equal to, we've computed this for year one, yeah? But again, I want that as a negative because that's a payment I'll make. So I just put negative before that cell. And so the same formula apply to year 5. The same formula apply to year number 5. So because we now have the cash flows, we now have all the cash flows per year, we can get the relevant cash flows. Like now for year 0, we have a total of 120 million. Then of course, for the rest of the years, we add them in the same manner. So those are there for the relevant cash flows. So that this answers part B of the question. That answers part B of the question. So is there a question on that? Is there a question on that? Okay, perfect. Thank you, Lillian. If that is okay, then the last part of the question, part C, yeah? The last part of the question, which is part C. Part C says that we now compute NPV of the project and then advise on the project viability. So NPV. So how much is NPV? Then advice. What is the advice? Yeah, so that Lillian, how much is that NPV? You have, remember you have the cash flows. These are the cash flows. So this is now the summarized cash flow per year. Year 0 to year 5, those are the summarized cash flow. Your cost of capital, we said this is 15% in part A, yeah? So with the cost of capital as 15%, and these cash flows, how much NPV do you get? We already learned how you compute it, yeah? So how much NPV are you getting? So calculate the NPV. Yeah, so Lillian, the relevant cash flows are don't worry, I'll send you the workings to the class WhatsApp group after class so that you have the right solution to the question. Yeah. The relevant cash flows are these ones. So they are the ones you should use together with the adjusted cost of capital, which we said is 15%. Yeah. So I'll send you this working after class, after we are done. Yeah. So remember, this is December 2022, question number 22. So I'll send you the workings. Don't worry. So based on that, how much NPV do you get? All right, so yeah, so Lilian, you say that the NPV comes to negative 12 million, yeah? So let me just confirm that. So that, of course, NPV, you type the function for it, yeah? You type equal to NPV in bracket, begin with the cost of capital rate, so the 15%, then you comma, and then of course you pick the values you pick from for the first year all the way to the last year, and then you close the bracket, then you say minus, not minus but plus the initial outlay, yeah? So correctly that comes to the negative 12 million and 55 that you had alluded to, yeah? So the advice is that reject the project because NPV is negative, and that's it, yeah? And that's it. So could there be a question on this? That answers this question fully, yeah? Is there any question on this? Any question? Yeah, no question. So if there's no question, then I will stop there, yeah? I will stop there. We meet next weekend when we will proceed to a new concept still under financial management, yeah? So in the meantime, I'm sending to you this Excel so that you have the solution to this question. But then I want you to attempt this question labeled exercise 2. In the same Excel I will send, yeah? The question labeled exercise 2, it is almost similar to the one we have done, yeah? So please attempt that. Please attempt that so that we are together. So please attempt that. You are finding the Excel in your WhatsApp group very shortly. So the question you are attempting is the one labeled exercise 2, the last sheet in the Excel which I am sending. So thank you very much. Let me stop there. You'll get in the WhatsApp group the Excel for today's question, yeah? So otherwise, thank you very much for being part of the class. Enjoy the rest of your weekend. Enjoy the rest of your weekend. So kindly attempt that and return it, attempt that and send it back so that I can look at what you have done, yeah? kindly attempt that question, exercise number 2, so that I get to look at what you have done. So thank you very much, and enjoy the rest of your weekend.